Here's a trade that I called out before time, before it even happened. I already had the time marked out, I had the zone marked out, I had the liquidity marked out. It was a continuation trade. And it won, 5R. It had better quality, better liquidity, but it lost. That's because liquidity itself in the market is absolutely useless, but the correct liquidity is the most important. All liquidity is not equal, and right now I'm going to show you. We're at the weekly time frame. We're going to do some basic market structure. The market comes in, it creates a high and a low. This low was swept. So at that time frame, it was bearish, but the same thing happened again. High. But this time, this high was swept and this high was swept, and this low was left alone, which means this entire barrel of price action was then surpassed, making an uptrend, and it continued to be an uptrend. High, low, the high was taken. Low, high, the high was taken. And then it stops. But this is what a concept called liquidity is. Liquidity is orders and stops. It is not highs and lows, but they do rest at highs and lows. So at all of these lows is a bunch of liquidity. That's because people are buying and selling or doing different types of trading strategies like breakouts and trend lines. But all of those people, likely or not, usually are liquidity. And this includes people who trade my strategy. So after all these highs and lows are taken, it goes lower, it takes them all out, and it uses them as fuel for the move to go up. Does the same thing again. It goes up, goes down, goes up, destroys that low, it continues higher. Liquidity can show itself in three ways. A trend line. B, equal highs and equal lows. C, just any high or any low. So in this case, A, this trend line right here. That's a terrible trend line. Let me try again. There we go. Trend line, 3 touches right here, right here, right here, right here. That's actually more than 3. Again, we have these relative equal lows on the weekly time frame, by the way. So that's like super good because on the higher time frame, it's usually more powerful. Same thing happens again, equal lows. And then just any high, any low being destroyed. And this usually is just an inducement. So it goes lower, then it goes lower, then this low, high, this high gets destroyed, then it goes lower. So we have 3 confirmations on why the trade should go up. We have A, this trend line. We have B, this random high getting destroyed for the liquidity. We have C, 2 equal lows. And then we have a high quality POI. A POI is just a point of interest, and a point of interest is usually at the start of the move. So this is where the move starts after hitting this zone. It hit it, it went up. Take a trade, take a pick. Why is it so large? Pause. And then you get a huge trade. On the weekly time frame though, this is a pretty large trade, but you get the idea. Didn't think that these quote unquote breaks of structures were real because they weren't real. These are not breaks of structures. This is the market changing course short term to collect liquidity and then go back up. However, if this low right here was taken and then after it took it, it went up, then to go lower, then I would say, yeah, maybe it would be. But the thing is, it took it and then went higher. So now I'm double sure it's bullish. And it was bullish, and I was correct. And then the bullish trend is continuing. We have low, high, high gets destroyed, low, high gets destroyed, low, high gets destroyed. The uptrend is continuing. That's all you need to do. Higher time frame to see our demand zones. You see this right here was the start of the move. This entire POI right here. Now why isn't it these? Well, because it went up, it went down 3% mark, and then it stalled for a while. But the expansion, these big bullish candles, only happened around this area. This was just a bunch of stalling liquidity. And guess what? It continues to the upside because we're on high time frame liquidity. This insanely great trendline liquidity. This high getting destroyed liquidity. All these lows getting destroyed liquidity. These equal lows right here. If you can't see it, I'll move this out the way. These are relatively equal lows. So that's also getting swept. These lows, sort of equal. They're getting swept. All these highs, they're getting swept. So we're seeing confirmation again and again. of the liquidity being taken, and it went into a great POI because not only that, but we're starting at the expansion of the move. So I guess you could say this would be the expansion, but the thing is, the market wouldn't inconvenience itself by going all the way down here most of the time. So technically this could be counted as the extreme point, but I would say this is the second to the extreme, which is what I call the second to the extreme. It's basically like the second option of the extreme. I don't count it as a decisional zone, because the decisional zone is usually a low quality zone, where this zone is a high quality zone. A decisional zone would be like, for instance, right here. It'd be higher than both of these trades and have less liquidity. But this is a second to the extreme precisely because it has more high quality liquidity. And if you would have taken your trade right here, stopped by the high, it would have won 11 RR trade. So A, obviously no basic market structure. B, trendline liquidity on the high time frame. Equal highs and equal lows on the high time frame. Equal highs and equal lows on the high time frame. Random highs and lows being taken on high time frame. Going to the POI, point of interest, supply and demand zone, that was at the start of the move. So, start of the move, highs being taken, trendline liquidity being taken, equal highs and equal lows being taken, goes into the zone, you win. Right, we're going to back test the market. We're going to do our basic market structure. How can you tell if it's major or not major? It's a very simple process. Basically, you just see what is larger than the other. So, for instance, this is not a major market structure because this is higher than the other. This is not a major low because this is lower. This is not a major low because this is lower than that one. So, this low right here, this high right here, major. Same process once again. This high, this low, most major. These cannot be more major than these two because these are higher than the other, which means they're higher quality and have more power and more liquidity and more orders resting there. So when this high is taken, we are shown explosively that this high has a lot of liquidity and fuel to push the market higher, which it does. And also, so trend is bullish because of the same thing once again. This low is left alone and this high is absolutely destroyed. It goes into a high time frame POI right here, where the start of the expansion of the move happens. All of these candles explosively goes to the upside after that. We have a lot of options for quality trades. This zone is pretty good. This zone is good. This zone's alright. But I think it's going to do something else. I don't think it's going to go lower just yet, so I'm going to be patient. I'm going to wait for a good trade, see good quality. The liquidity here is alright, but it's not good. We don't see any trend lines. All we see is just up, down, up, down. This liquidity is alright, but it's not a lot because we're on the 3-minute time frame, which means we're just seeing minimal liquidity. We're not seeing any powerful moves here. Even if this trade works out, it wouldn't be a safe trade to take. Let's see what it does. Alright, 1-6. By the way, the POI that I was using on this trade, I don't think I showed you, but it was actually this one right here. Now you may be thinking, well, doesn't this one cause the expansion of the move? Yes, it does, but I'm scalping, so on the high time frame, yeah. It's actually this entire area that causes the expansion. I think it did. I'm going to count it. And even if not, I'm going to make a bigger trade for this one. Okay, let's trade once again. I want to show you a loss though, but I'm not losing. Let me just try to lose real quick. Right, so for example, this trade probably won't win. Actually, maybe it would, but I doubt it. Yeah, okay. So this trade, if you would have taken it, would have lost because its quality of liquidity is too little. Sure, the strike was high and this low was left alone at the time of the trade. But the thing is, the quality of the liquidity was too little because you're on the lower time frame, which means liquidity is weaker. So yes, it had a trend line. Yes, this low, not this low actually, this low was taken. This low also was taken, relative equal lows. That all makes sense. This trade got a great reaction and you would have won. Why? Because sure, we're on the low time frame liquidity, but on the higher time frame, it is aligned with it. And I'm probably glad that I missed it, because if I would have placed it for a higher RR trade, it would have lost. But hey, for a good 1 in 5, you would have won. Okay, goes to the extend expansion, hits this low, takes all this liquidity. And another win.